I don't care what you see, gold dropping below 2000. You're seeing massive deliveries off of COMEX still over the last couple of weeks. Huge deliveries coming out of COMEX and huge deliveries coming off the LBMA, and gold being priced, almost $100 higher on Shanghai, and silver almost $3 higher on Shanghai. The big money is accumulating and arbitraging and siphoning gold and silver using these ridiculous prices of the West. And yes, 2000 ought to be support, but the reality is it should be a whole hell of a lot higher, and silver should be much, much, much higher.
The gold market is navigating complex challenges, including higher than anticipated inflation rates, surging Treasury yields, a strengthening U.S. dollar, and evolving Federal Reserve rate policies. These intertwined factors are reshaping the landscape of the gold market, creating a dynamic environment for investors to navigate. Despite occasional dips in gold prices below $2,000 per ounce, Andy Schectman, CEO of Miles Franklin, dismisses these short-term fluctuations as mere noise, emphasizing their limited impact on the market's long-term trajectory. Instead, he points to significant deliveries off exchanges like COMEX and LBMA and price disparities between Western exchanges and Shanghai as indicators of underlying market strength. Additionally, major players' accumulation of gold and silver persists despite price fluctuations, suggesting that these metals should be valued higher based on market fundamentals. As we have seen, central banks have been actively bolstering their gold reserves since last year amidst escalating geopolitical tensions and economic uncertainty. This uptick in demand from central banks has emerged as a key driver of the gold market in recent years, as highlighted by the World Gold Council. In 2023, central bank demand for gold reached 1,037 tons, marking a slight decline of 4% from the record levels seen in 2022. However, this still represented the second consecutive year of central bank purchases exceeding 1,000 tons. The continued accumulation of gold by central banks underscores the enduring appeal of precious metals as a store of value despite short-term market fluctuations. This trend not only reflects confidence in gold's role as a hedge against economic uncertainty, but also signals a broader shift in global monetary policy dynamics. As such, while the gold market may face challenges in the short term, the underlying fundamentals remain strong, providing a solid foundation for long-term investors. We will present clips from Andy Schectman's interview with Arcadia Economics, but before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Inflation is coming in much hotter than they anticipated, and well, that's not much of a surprise as far as I'm concerned. But the numbers that we keep, being told, whether it be employment numbers and the price goes down, or the inflation numbers, they just seem to be less than accurate, I guess you could say. And the market reacts, or it is given a little bit of a push to react to those markets, certainly to make the system in an election year seem stronger than it is. They bring out all these big employment numbers in January. They will be revised just like the entire 2023 numbers were revised downward by 40%. The revision in the unemployment numbers and the lack of clarity and transparency and the changing of the metrics used for gauging inflation in the CPI is justification when these numbers come out for short-term gyrations in the price of gold, and it's just more of the same. The noise, as far as I'm concerned, it's all noise, and the short-term movements, the short-term gyrations, the short-term technicals, to me, don't have much bearing whatsoever on the ultimate direction of the market moving forward. And again, look, I don't care what you see, gold dropping below 2000. You're seeing massive deliveries off of COMEX still over the last couple of weeks. Huge deliveries coming out of COMEX and huge deliveries coming off the LBMA, and gold being priced, almost $100 higher on Shanghai, and silver almost $3 higher on Shanghai. The big money is accumulating and arbitraging and siphoning gold and silver using these ridiculous prices of the West. And yes, 2000 ought to be support, but the reality is it should be a whole hell of a lot higher, and silver should be much, much, much higher. One of these days, you will see a positioning like we see right now, where the commercial banks are in a very bullish position and the manage money in a very, very, in a short position and in a compromised position should the price start to go higher. And the question is, at what point will the commercial banks not sell into a rising market? That's really the question here. And Ted Butler talks about this all the time. Maybe we'll see that happen this time. Maybe this will be the move up. Maybe it won't be. But through all of this noise, we see the most well-funded and well-informed traders on the globe continue to drain the exchanges, continue to accumulate, using this price, this volatility in this tight trading range that people make a big deal of. But look at it from a step back. It's been in a trading range forever with great volatility. That's enabled the big money to pickpocket the exchanges. If it goes too low, it gets too much attention. If it goes too high, it gets too much attention. But keep it in a tight trading range with great counterintuitive and volatile price action, and you can systematically drain the exchanges. So I think the mistake a lot of people make is looking at the micro and looking at the short term and look at the big picture and see that the economic picture, see the big picture with the BRICS, see the big picture with the central banks accumulating it, see the big picture with the exchanges being bled dry, and then see the big picture growing of arbitrage rearing its head on the Shanghai Gold Exchange. The fact that silver is almost $2.80 or 90 cents an ounce higher in Shanghai than it is on the LBMA and the COMEX is a massive deal, where you will see more and more metal arbitraged off for those big traders that have access to both. And I think this will come in a very abrupt fashion, where one of these times the managed money gets caught with their pants down. They continue to think that everything is the same, and recency bias enables them to go naked short to very large positions. And as the price starts to rise, they'll have a very hard time finding anyone, i.e. the commercial banks, willing to sell metal to them at the prices that are being quoted on Western exchanges, which I think just about everyone watching this show would say are too cheap.
Andy expresses deep concern about the current economic trajectory, foreseeing a looming recession or slowdown compounded by declining M2 money supply and reverse repurchase agreements. The M2 measure of the money supply soared 41% in 2020 and 2021, the fastest since World War II. This measure of the money supply then declined 3.2% in 2022 and 2023, the largest two-year drop since the Great Depression. These developments would intensify strain on banks and the economy, potentially accelerating an impending crisis. Over the past several months, a string of stronger-than-expected data had many investors embracing a possible soft landing in which inflation would fall to the Federal Reserve's 2% goal without a severe economic downturn. Recent data over the past week has challenged that narrative. January inflation reports from the Consumer Price Index, CPI, and Producer Price Index, PPI, showed prices increased more than economists projected in the last month. Yet Andy perceives the notion of a soft landing, arguing that complacency prevails despite looming economic challenges. He warns that the current calm could be the calm before the storm, anticipating that the worst is yet to come. Let's get back to the interview.
And so, yeah, I think that a recession, I think slowdown, coupled with the M2 money supply falling, coupled with the reverse repo, these are all very, very scary things that I think ultimately put greater strain on the banks, put greater strain on the economy, and will only, I think, accelerate this event that people see coming with the banks and the consolidation of the banks, which will then start to also greatly, I think, affect the commercial real estate market. And think of all the businesses that spring up around all of the big buildings in the inner cities that are already experiencing crime and lawlessness and mass exodus. Over $1 trillion worth of businesses left New York City in the last year. And why would they stay there after what we see happening there? And more business leaving these cities, making the commercial real estate that much worse, hurting the small businesses around there that much more. And who owns all the loans? But the regional banks. Well, what does the modern monetary theorist want? I.e. the number two in charge, Lael Brainerd at the U.S. government, the consolidation of the banks. And this is exactly how you do it. You incentivize people to overextend, whether it be in their business operations or in their asset purchases or whatever it may be. And then you raise rates 11 times in in a year and a half or whatnot. And now they're talking about not maybe pivoting. In fact, you got Lauren Summers coming out and saying, I think they're going to raise rates. Well, we've been saying that. We've been saying they're not going to lower rates. They can't. If they do, they've lost all credibility. And now inflation is hotter than they thought. So are they actually going to raise rates next time? Which is going to put more strain on the banks and more strain on the commercial real estate. It's a doom loop. And I think people are way too complacent right now. They're sitting in the eye of the storm thinking all is good. Soft landing is coming. No, it ain't coming. But by the information, when you look at these massive layoffs and then you look at the BIS, let's take the I out of that and just call it BS, saying that 300,000+ jobs were issued in January. They will come back and revise those numbers. But at the same time, we're seeing massive good paying full-time jobs being shed in favor of 2 or 3 part-time jobs to make ends meet, blurring the reality of these employment numbers. And I don't even need to go down the road with inflation, but I'll tell you, inflation is here to stay. And I think it only gets worse moving forward, putting even greater strain on this whole system. Then rates got to go higher than the whole thing. I mean, you can see it's a doom loop. So yeah, I think that this is the calm before the storm, Chris. I think we haven't seen anything yet. I agree with Luke that you don't need to see a common settlement currency or a common reserve currency, because look, if you look at the price at the value of gold since 2000, it's appreciated by 7.8% per year. The S&P 7%, the bond market a fraction of that. So when you look at these countries, they say, look, what the hell do we need to take the dollar and buy treasuries for? That was the petro deal. You value oil in dollars and take the excess and put it into treasuries. But why hold treasuries when last year, for the first time in 45 years, they were way more volatile than the gold price? But go back to 2000. Gold is appreciated by almost 8% per year, and it doesn't have counterparty risk, and it doesn't have the risks associated right now with this system, interest rate and inflation risk, the way that the bond market does, or the default risk. And it has no counterparty risk.
The strong January inflation reading in the United States led to a correction in spot gold prices to below $2,000 an ounce last week. Yet analysts believe the price of the yellow metal may still find continued support at these levels. Of course, near-term volatility will persist and be driven by geopolitics and economic data. While gold has been down by some 2% since the start of the year, the demand for the precious metal remains solid due to the continued geopolitical risk, which may endear the commodity worldwide. We would love your thoughts on Andy's predictions in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching. For